I'm really excited to be here for the week of August the 16th for your mortgage Q&A. So we'll be here until I run out of questions, basically. So there were a couple of questions that came up over the last week, and if anyone has any questions live, I'm happy to answer them for you now. And if you don't have any questions, I have a couple of things we can talk about as well. So Michael Black had asked a question over the week, and let me just read it out here, and then we can talk about that. Great question, Michael. So his question was, let's see. He said, with the unstable economy and the challenge for entrepreneurs to qualify for mortgages, would it be better to get into a rent-to-own scenario and try the house on for size? And, you know, that's a great question. So when you, as a first-time home buyer or as someone who's thinking about a rent-to-own program, it's really important to make sure that the contract is there and it benefits you as well as the investor. So you want to make sure that on your side, you're going to get a benefit from that contract. So what I mean is that when you do rent-to-own, typically you're paying the mortgage payments you would normally pay, and you pay a little extra to build up a savings. They also typically ask you to provide an additional down payment, and you're giving this all to the person who is arranging the rent-to-own contract. And so if you're giving someone else your money, and then you're going to sign a contract to say you're going to make specific payments, and you're going to make them extra payments towards the down payment. And then over a period of time, usually 2 or 3 years, then you'll buy the home from them at a set price. So it's great if the market is going up, then you will see an increase, and the house purchase price that you get might be higher than the contract price. But if the market's flat, the purchase price of the house may be higher than what you could buy it for if you just were a regular home purchaser. And so you would have basically lost all of that down payment you gave towards the contract or the down payment you gave to the investor. So you have to be quite careful and make sure you're in an upward environment. In my opinion, if you just save the money yourself, get into a rental position, and really watch your cash flow, it's probably much more beneficial for you. You can put the money away yourself. You get to manage the money. You're in a rental property, and you might not have to pay as much for rent, and so you could save more money. You have more control that way. And so for most people, I think that renting and saving themselves is a better idea. But there are some rent-to-own programs that are beneficial, especially if it's in a very increasing market, because the price of your house could be substantially higher, or the value of your house could be substantially higher than the purchase price you end up negotiating. So hopefully that answers your question, Michael. Great question. Thank you very much. I'll look and see if there's any other questions here. No, we don't have any right now. What I thought I could also talk a little bit about today is the home buying process. So let me just get some information here for you about that, and then we can talk about the home buying process. Let's see. Sorry, let's see. Okay, so I'll share my screen here, and then I'll let you take a look at this, and we'll talk a little bit about this. So here you go. So if you're a first-time home buyer, or you're a buyer of any sort, then from the mortgage perspective, we can talk a little bit about mortgage process and what's involved in qualifying for the purchase of a new house. Initially, what you want to do is get together with your mortgage broker, with me, and we're going to review some of your details, get some details about you, take a look at your income and how much money you have for down payment. And then I'll ask you for some documentation so that we can support the information you've given me. And with these two things, and then also checking your credit, then we can figure out how much you qualify for. And that way we do that is it based upon your down payment. If you have less than 20% down, then we have to have the mortgage insured through CMHC or Genworth or Canadian Guarantee. And these three companies insure the lender. They don't actually insure you, they insure the lender to prevent them from making any losses. And they charge a premium to do that, and it's just added onto your mortgage. So with 5% down, the premium is 3.6%. With 10% down, it's 2.4%. And then 15% down is 1.8. And there's specific qualifying criteria that CMHC and Genworth have, so we would know whether or not you qualify with that or not. If you have a purchase with less than 20% down, the maximum amortization is 25 years. If you have 20% down or more, then the maximum amortization is actually 35 years. So we can help you to qualify for a bigger mortgage. So what we say by qualifying is that 35% of your income can go towards your property taxes and heat and your mortgage payments, and then half your condo fees. So they go to your housing costs, and then 42% of your income can go towards all of your costs, including your housing and credit cards and loans and that sort of thing. You see the numbers in blue here, and that's if you have really good credit. We can actually go a little higher, 39% for your housing costs, and then 44%. So you see there's a difference between these two numbers, and that means it's possible for you to have some debt as well to when you want to qualify for a house. You don't have to be debt-free to qualify for a house. You can have debt, and that can be quite a bit. Up to 7% of your income can go towards paying off your debt. So once you're pre-qualified, then you go out and you search for a place, and then you'll find a house and you'll write up an offer. And at this time, you're going to give a deposit. So you'll normally give, say, $5,000 or $10,000, and that'll be given at the time to the realtor you're working with, and they'll give it to the vendor's realtor. And the realtor will send the purchase agreement and the MLS to me so that we can get you pre-approved through the bank. We send that all off to the bank, and then they're going to come back about a day or so later with a commitment. Usually when you write up the offer, your realtor will give us some time, so 5 to 7 days for us to go through this process, right down to here. So we've got 5 to 7 days to go through this process, and you'll want to make your conditions to financing, make it subject to home inspection. If you want to get any quotes on your house, then you'll want to make it subject to any quotes and contractor going in to look at your house. Once they forward me all those documents, again, I'll get an approval usually back within a day, and then we'll review that commitment from the lender, and then we'll try to meet all the conditions. So we'll review and sign the commitment, and then we'll get some more documents from you if there are any more required, so that we can finalize the mortgage. Once it's all finalized and the bank is really happy with you, then you can waive your conditions to financing, and the bank is going to send all the documents to the lawyer. The lawyer, they really have 3 key things that they do for you. They act with the money, so they handle all the cash for the transaction. They register the mortgage for the bank, and they also register your name on title. So you want to make sure your name's registered on title, because you don't want to register in someone else's name. So it's a really important part that the lawyer has. Normally, legal fees in Alberta range from $1,500 to $2,000, something like that, and that's what you could expect to pay. And then the other things you might pay here would be definitely the balance of your down payment. So up here, when you purchase your house, let's say you gave $5,000. Let's say you bought your house for $400 and you had 5% down. So that means you have $15,000 left, and you'll give it to the lawyer here. Normally, you'll meet the lawyer about a week to 2 weeks before possession, and you'll bring him that cash, and you'll want to pay him, have enough there to pay him his legal fees, so say $2,000. Another thing you want to think about is the property tax adjustment. In Calgary here, property taxes are due on the 30th of June, and so if the vendor, the person selling the house, has paid their property taxes on June 30th for the whole year, and you may move in July 1st, then you're gonna owe them for the whole year. But if the property owner, if you move in, say, April 1st and the property owner hasn't paid their taxes yet, then they're going to owe you some money for the months that they lived in the house but didn't pay the property taxes. So there's going to be a property tax adjustment typically when you move into a house, and it depends on whether or not you move in before or after June 30th, whether you get a credit or not. The other factor is if the current homeowner is paying property taxes through the City of Calgary TIPS program. So that means they're paying monthly, so every month they make a property tax payment. And if that's the case, then normally you would just take over those payments on the 1st of the following month, and you'd make an adjustment within the month that you moved in for any property taxes that are paid by the current owner. Finally, there's me, the mortgage broker, and generally when people are purchasing a house, I don't charge any fees, so the bank actually pays me to help you facilitate the process, and so you don't pay any additional fees to me to purchase the property. In some cases, when we can't find a bank who will pay me a professional fee, then I will have to charge you a fee. But in 90% of the time, 99% of the time, when you're purchasing a house, then you don't pay me any broker fees. And then finally, once all of this stuff is done, then you get to move into your new house. Normally the day before you move in, you'll go do a walkthrough again, just to make sure all the house is in the proper condition. When you go to look at it, this could be 2 or 3 months prior to purchasing your house. So you're looking at it up here, and you want to make sure the same appliances are there, and the house is in the same condition that you found it, or if you have some conditions that you wanted or terms of the contract where you wanted to have the vendor pay for something or fix something or remove something, say junk in the backyard, if there's a bunch of junk back there and you wanted it removed, then here you want to check to make sure it's done. If it's not done, then you want to advise your solicitor and say, hey, you know what, this guy didn't remove the junk. It's going to cost me at least $1,000 to get this done. Can you hold back some of the money you have from giving it to the vendor, and so that I know that if he doesn't do this by the possession date, that I can get it done and I can pay the money myself. And so that's something that you can do with your property before you take possession. So it gives you control of making sure stuff is done. And then, woohoo, this is the possession date. Exciting time when you get to get your keys and move all your stuff in, and then you're in the home of your own. Once you're in there, what I normally recommend you do is settle in before you start paying off your mortgage much faster. You want to make sure you understand what your costs are, because it's going to be a little different than renting. You're going to want to buy stuff, you're going to want to fix stuff up, and so you may have some extra costs that you didn't originally think about. And so, settle in for 3 to 6 months, even a year, before you decide to start making lump sum payments. But every bank allows lump sum payments, and so typically it's 15 to 20% of the original mortgage amount that you can pay down, and you can do that normally anytime throughout the year. And also you can increase your payments, so to make it easier to pay your mortgage down faster, you can just increase the payment by a little bit. So make an affordable increase if you want, and that's something I usually like to just review with you and chat with you about your affordability and what you plan to do, and see if increasing mortgage payments down the road is an option. And in another episode, we'll talk a little bit about interest rate risk and how that works, and why you may want to increase your payments even though your mortgage rate isn't changing. So we'll talk about that in another episode. Another thing you can choose is the frequency of your payments. You can make a monthly payment, bi-weekly payment, or weekly payment. Basically, weekly and bi-weekly will pay off your mortgage faster, but that's because you're paying more towards the principal every year. So as you can see here, 12 months at $1,000 a month, $12,000, but 26 weeks at $500 a week is $13,000. So you end up paying an extra $1,000 or 1 month's payment by doing an accelerated bi-weekly payment, and you end up paying the same, an extra $1,000 by doing accelerated weekly. You can do the same thing monthly if you get paid monthly. Just increase this payment by 8.3%. So make it $1,083 a month instead of $1,000, and it'll be exactly the same, $13,000 in a year. So you'll pay it off just as fast. So it's not the frequency that matters; it's the amount that you pay that's really important when you qualify for, or when you want to pay down your mortgage. And again, we can chat about that and what's comfortable and what you want to do. Some terminology we always talk about is the term. The term is the time that the contract is fixed. most first-time buyers take a 5-year term, but some people like a shorter term, 2 years, 3 years, somewhat longer, 7, 10 years. But that's the time the interest rate is guaranteed, or the discount is guaranteed. If you have a variable mortgage, you'll have a guaranteed discount to the prime lending rate that stays for that period of time. And then the other is the amortization. That's the time it takes to pay it off to zero. And so if you want to pay it off faster or make a bigger mortgage payment, then that'll affect the amortization. It'll go down. If you reduce the amortization, then the payments go up. So they have an inverse relationship. So let's just check again and see if anyone has a question. I'll just unshare my screen here and see if there's any other questions. And if not, then I will say goodbye. And it looks like there's no more questions. So thanks very much for listening and watching this episode. And please come again, and I'm happy to answer any questions you have. And the same time, same place, 7:30 on Tuesday night next week. So talk to you then. Thank you very much.